Hello, friends. There is a $6,000 tax deduction sitting in the law right now, written specifically for people 65 and older, and a large number of the seniors who qualify for it are going to file their taxes this year without ever claiming a single dollar of it. Not because they don't deserve it, not because they earn too much, simply because nobody sat down and explained that it exists, who it's for, and exactly how to put it on your return. That's what I'm going to do today. By the end of this video, you'll know whether this deduction belongs to you, how much of it you can actually take, the one income line that can quietly shrink it or erase it, and the exact form it goes on. Stay with me, because the people who understand this before they file keep the money. The people who don't hand it back to the government without ever realizing it was theirs. Before we get into it, if you're not subscribed to this channel, please do that right now and turn on the bell. Here's why it genuinely matters. Tax law for seniors changes, and when it changes, the IRS does not call you to explain what's new or what you're now entitled to. They publish a rule and expect you to find it. What I do on this channel is take those changes, break them down by what they actually mean for your situation, and get that to you before the filing deadline passes and before the money is gone. This deduction is a perfect example. It's brand new, most seniors have never heard of it, and it does not last forever. Subscribe, turn on the bell, and let's get into it. So here's what this actually is. In the summer of 2025, a new tax law created an additional deduction of $6,000 for individuals who are 65 and older. $6,000 per person. If you are married, filing jointly, and both you and your spouse are 65 or older, that's $6,000 each, $12,000 off your taxable income as a couple. And I want you to hear this clearly, because this is where most people get confused. This is not the regular standard deduction. It's not the extra standard deduction seniors have always gotten. This $6,000 is on top of both of those. It stacks. Whether you take the standard deduction or you itemize, you can still claim this. It sits on top of everything else you are already going to get. Let me make that real with actual numbers, because numbers are the only thing that tells you the truth. Take a single person, age 72, with an income around $70,000. For this year, that person gets the regular standard deduction plus the existing extra deduction seniors get for being over 65, and now, on top of all of that, this new $6,000 deduction. Add it all together, and you're looking at well over $23,000 coming straight off your income before a single dollar of tax is calculated. That's not a refund you have to chase. That's not a check you have to apply for. It's income the government simply stops taxing if, and only if, it ends up on your return. Now here's the part that matters most for the people watching, and I want you to listen closely. You do not have to be receiving Social Security to claim this. A lot of seniors assume this is a Social Security thing. It's not. It's an age thing. If you are 65 or older by the end of the tax year and you have a valid Social Security number, you are in the door. And here's something that surprises people. Because this deduction lowers your taxable income, it can directly reduce, and in some cases completely wipe out, the federal tax you pay on your Social Security benefits. It doesn't change the rules on how those benefits are taxed. What it does is pull your overall income down far enough that the tax on them shrinks. For a lot of retirees with modest incomes, that can mean owing nothing in federal tax at all, but only if it's claimed. Now the warning. Because there is always a line in the law that takes back what the headline gives you, and here it is. This deduction has an income limit, and above that limit it starts to disappear. If you're single and your modified adjusted gross income climbs above $75,000, the deduction begins to shrink. For married couples filing jointly, that line is $150,000. And it doesn't shrink slowly. For every $1,000 of income above that line, you lose $60 of the deduction. Climb high enough and it's gone completely, around $175,000 for a single person, $250,000 for a couple. Why does this matter to you specifically? Because a one-time event can push you over without you planning for it. Selling a property, a large withdrawal from a retirement account, cashing out an investment. Any of those can spike your income for a single year and quietly cut into a deduction you would otherwise have gotten in full. If you have any control over the timing of income like that, this is the year to think carefully about it. Spreading a sale across 2 years or pulling a withdrawal back can be the difference between keeping the full deduction and watching it evaporate. Now, how you actually claim it, because this is where people lose it through a simple paperwork mistake. This deduction goes on your federal return, and there is a specific schedule that came with it, a new form attached to your 1040. If you use a tax preparer, you say these exact words to them. I want to make sure you're claiming the new senior deduction for me. If you file your own taxes with software, look for the senior deduction section and confirm it's been applied. Do not assume it happened automatically. And here is the most important sentence in this entire video. If you already filed your taxes for last year and you did not claim this, you are not out of luck. You can file an amended return. The form is a 1040-X. You go back, you add the deduction you missed, and the IRS sends you the difference. People leave thousands of dollars sitting with the government every year simply because they think a filed return is final. It isn't. You have time to correct it. And there's one more thing you need to know, because it changes how urgent this is. This deduction is temporary. As the law is written right now, it applies to the tax years 2025 through 2028. And then, unless Congress acts to extend it, it expires. That gives you a window, a few years where this $6,000 per person is available, and then a date where it's scheduled to vanish. So this is not something to file away and deal with someday. This is a now thing. Every year you qualify and don't claim it is a year of that money gone for good. So let me bring this all together so you know exactly what to do. If you are 65 or older, this deduction is $6,000 per person, $12,000 for a couple where both of you qualify, and it sits on top of your standard deduction whether you itemize or not. You do not need to be on Social Security to claim it, and it can lower or even eliminate the tax on your benefits. Watch your income, because above $75,000 single or $150,000 married, it starts to shrink, and a one-time sale or withdrawal can be what pushes you over. Make sure it lands on your return through the correct schedule. Tell your preparer in plain words to claim it. And if you already filed without it, file an amended return and get back what's yours. And remember, this is only on the books through 2028. After that, it's scheduled to be gone. This is real money, and it belongs to you, not the government, but only if it ends up on the paper. Subscribe, turn on the bell so the next change reaches you in time, and share this with someone you know who is 65 or older. There is a very good chance they have no idea this exists, and you might be the reason they keep $6,000 this year.